Hey everyone, welcome back to Gold Rush Reporter. I'm your host, bringing you the latest updates and analysis on gold and silver, the metals that protect wealth and tell the real story behind the numbers. Today, we're diving into something that is absolutely critical for anyone following the precious metals market: the physical demand for gold and silver right now, and how it's signaling a major shift in the market. This isn't just some chart theory. This is real-world delivery data that's showing us where the smart money is moving, and it's something every serious investor should understand. We're only a few days into the December delivery month, and the numbers are already staggering. Just 2 days in, we've seen 23,970 gold contracts stand for delivery. That's 2.397 million ounces of gold physically demanded. On the silver side, 8,305 contracts have been issued and stopped, representing 41.5 million ounces. And this is just the beginning of the month. To put that in perspective, November isn't even a scheduled delivery month, and we still saw almost 20 million ounces of silver and 1.26 million ounces of gold delivered. That's extraordinary. It's structural demand, not seasonal fluctuations, and it tells us that the physical market is stronger than most people realize. The pace of these deliveries is accelerating in a way that few in the mainstream understand. Since October 1st, nearly 90 million ounces of silver have moved off the COMEX. Think about that for a second. The Western exchange system is literally being drained of metal at a record pace. This is the type of activity that signals a market under stress and points to a shift from paper promises to real physical ownership. For years, the system ran on trust. You bought a contract and you trusted that the metal could be delivered. But right now, that trust is being tested. Inventories are shrinking, delivery volumes are skyrocketing, and positions being stood for delivery are exposing weaknesses in the system. This isn't just theory. It's happening in real time. The COMEX and LBMA are built on decades of trust and liquidity, but when delivery demand exceeds available supply, cracks start to appear. The system works until it doesn't, and that's exactly what we're seeing. For the first time in a long while, serious players, not retail traders, are taking delivery in enormous amounts. We're talking about sovereign funds, industrial giants, and major hedge funds who want the metal in their hands, not just a paper claim. And here's the key takeaway. This isn't a normal market cycle. The numbers are showing us that demand for physical silver and gold is reaching levels that the Western delivery systems struggle to handle. This is the beginning of a story that could redefine price discovery for precious metals. The paper games are fading, and real metal is commanding the market. Stay with me, because in the next part, we'll dive even deeper into the COMEX dynamics and why this could be a historic turning point for silver. Let's jump right into the numbers, because this is where the story gets really interesting. Only 2 days into the December delivery month, and the activity is already off the charts. So far, we've seen 23,170 gold contracts standing for delivery. That's 2.397 million ounces of gold physically demanded. Silver is even crazier, with 8,305 contracts standing, which comes out to 41.5 million ounces. And this is just the start of the month. To put that in perspective, November isn't even a scheduled delivery month for gold or silver, yet we saw nearly 20 million ounces of silver and over 1.2 million ounces of gold delivered. That's not normal. That's not seasonal. That's structural demand showing us that serious players are moving in. We're not talking Reddit traders here. We're talking sovereign wealth funds, hedge funds, industrial giants, people who want the physical metal, not just paper promises. Now, here's where it gets critical. Since October 1st, nearly 90 million ounces of silver have moved off the COMEX. That's an enormous volume, and it shows a pattern. The Western system is being drained. The COMEX, the LBMA, The entire framework of the Western precious metals market is built on trust. If you buy a contract, the expectation is that you can take delivery. If the metal isn't there or delivery fails, trust cracks. And right now, trust is starting to crack. The system has massive short positions, especially in silver. SLV, the biggest silver ETF, holds one of the largest short positions ever. Meanwhile, the LBMA is struggling with supply, and delivery systems are slowing. This combination, huge demand for physical metal, weakening inventories, and massive shorts, is a recipe for disruption. You might be thinking, why does this matter to me? It matters because when trust in the system erodes, price discovery shifts. The paper markets in the West no longer control the true price of silver. That's why I keep saying that all roads are pointing to Asia, especially Shanghai, as the next real benchmark for physical silver. Cash and carry replaces rehypothecated promises. You buy metal, you get metal. No tricks, no delays, no phantom ounces. The key takeaway here is simple. The physical market is speaking louder than ever. Record deliveries, structural demand, and cracking trust are combining to create a scenario where silver is positioned to move higher, faster, and more dramatically than most investors realize. And gold isn't far behind. The same forces that are impacting silver are already supporting strong momentum in gold, setting the stage for a historic run in both metals. Now let's talk about what's happening behind the scenes with delivery systems and why this is so critical for silver and gold investors. The COMEX and LBMA are under pressure like never before. You've got record delivery numbers, massive short positions, and inventory shortages all happening at the same time. Normally, these systems rely on trust. If you buy a contract, you get the metal. But when trust starts to crack, everything changes. Think of it like a bridge. A bridge can hold thousands of cars, but only up to a point. The COMEX has been able to handle enormous volumes for decades because people believed in it. But when delivery demands hit historic levels, the bridge starts to strain. And what we're seeing now is that strain turning into cracks. The system is showing signs of stress, and these cracks are not just technical, they're fundamental. Look at silver. Nearly 42 million ounces demanded in the first 2 days of December. That's huge. And remember, this is a scheduled delivery month. But November, which shouldn't have much activity, saw almost 20 million ounces delivered. That's structural demand, signaling that the market is moving from paper contracts to actual physical metal. The same is happening with gold. 2.4 million ounces of gold standing for delivery in just 2 days. This isn't normal market behavior. This is a market that's being physically drained. Here's the really important part. The Western system is heavily reliant on paper markets, derivatives, and short positions. SLV holds one of the largest short positions in history, and the LBMA is running thin. The combination of huge demand for physical metal and these massive shorts is exactly how financial accidents happen. It's the perfect storm. When the system fails, it won't be gradual. It will happen fast. What's next? Trust in the Western price discovery mechanisms will continue to weaken. When that happens, all eyes turn to Asia, especially Shanghai, as the new price benchmark. Cash and carry will replace rehypothecated promises. You pay, you get your bars, and that's it. No naked shorts, no phantom ounces, no delays. This is why serious investors, sovereign funds, and industrial buyers are quietly moving into physical silver now. They know that when the shift happens, it will be too late to buy at today's prices. The takeaway is simple. The physical market is speaking louder than paper markets. Delivery numbers, structural demand, and massive short exposure are converging to create a historic scenario. Silver is set for a major move, and gold is following closely. Retail investors are still asleep, but the institutions are already making their moves. Now, let's dive deeper into who's driving this historic demand and why it matters so much. It's not just retail investors stacking a few ounces at home. We're talking sovereign wealth funds, industrial giants, and top-tier institutional investors quietly moving massive amounts of physical silver and gold. These players aren't in it for a quick trade or a social media flex. They are taking delivery, locking it in vaults, and ensuring control over their assets. Since October 1st, nearly 90 million ounces of silver have moved off the COMEX. That's staggering, and it's accelerating. This isn't normal market behavior. It's a structural shift. The Western markets, built on paper contracts and trust, are starting to show cracks. The delivery systems are being stressed to the limit. When trust breaks, the game changes completely. It's like the COMEX bridge I mentioned earlier. It can hold the weight until suddenly it can't. And then the collapse is fast and unforgiving. Let's talk Asia, because this is where the story gets even more important. Shanghai is already positioning itself as the go-to market for physical settlement. Unlike the Western exchanges, where rehypothecation and paper trades dominate, in Shanghai, you buy the metal, you get the metal. It's a cash and carry system. No naked shorts, no phantom ounces. That shift is inevitable if the Western system continues to struggle with massive delivery demands and shrinking inventories. Meanwhile, China is aggressively accumulating physical silver. They're buying doré and concentrate in Mexico and Peru, paying well above global market prices and shipping it home for refining. They are not selling into the market, they are hoarding. The EU and US have reclassified silver as a critical mineral. Strategic accumulation is happening across South Korea, Turkey, and Russia as well. Every ounce leaving Western inventories and entering Asia strengthens the physical market there while weakening the West's ability to influence pricing. Here's the bigger picture. Paper markets have dominated for decades. Banks, ETFs, and exchanges like the COMEX and LBMA have controlled pricing through massive shorts. But now, physical demand is breaking through. When the first major Western institution fails to deliver, trust will collapse instantly. The world will look east, and the physical market in Shanghai will set the new standard. What does this mean for silver and gold? Prices are being pushed higher by real physical demand, not speculation. Structural deficits, coupled with increasing industrial and sovereign demand, are creating a historic setup. Every correction is likely to be bought aggressively. Retail may still be asleep, but the big money is stacking now. Now let's get into the technical picture, because it helps us see where silver and gold could be headed next. Looking at the COMEX and global charts, silver is forming one of the most bullish setups I've seen in years. We have a massive cup and handle pattern that has been building over time, and it's finally breaking out. The handle is complete, and the breakout above $50 has already happened. If we use classical technical analysis, the top of the cup in 1980 was $50, the bottom in the 1990s was around $4, giving a difference of $46. Adding that to the top suggests a potential target of about $96 for silver. And that's without even considering current structural demand or geopolitical factors. The silver to gold ratio adds another layer of insight. Historically, it has averaged around 45 to 1, meaning 45 ounces of silver for 1 ounce of gold. Right now, the ratio is collapsing towards 7 to 1 in some reports, indicating silver is dramatically undervalued relative to gold. Even using a more conservative ratio of 42 to 1, with gold around $40, silver should be near $95. The charts, ratios, and fundamentals all point to a huge upside. Gold charts are equally bullish. The long-term cup and handle is complete, and gold is approaching all-time highs. Technical breakouts, combined with strong institutional buying, suggest we could see $5,000 gold in 2026. Patterns like ascending triangles and bull flags in gold and silver charts indicate a continuation of the bull trend. Every time there is a minor consolidation, it's being absorbed before the next breakout. This fractal behavior has been consistent throughout this bull market. The COMEX delivery data supports this technical setup. In just the first 2 days of December, 23,970 gold contracts, 2.397 million ounces, and 8,305 silver contracts, 41.5 million ounces, stood for delivery. That's huge volume driving real physical demand. When you combine that with the ongoing deficits, industrial usage, and sovereign accumulation, the technical patterns start to make sense. Price moves aren't just theory. They're being enforced by physical market pressure. Junior and senior miners are following the same trend. CLJ, the Junior Silver Miners ETF, has formed a bull flag and is ready for breakout. GDX, the Senior Gold Miners ETF, mirrors this pattern. These ETFs often amplify gains in precious metals, meaning mining stocks could soar alongside silver and gold. In short, all the technical indicators, historical ratios, and physical demand data align. Silver is positioned for a major breakout, and gold is heading toward record highs. The next target levels are clear: $96 for silver based on classical patterns, and well over $5,000 for gold if the breakout continues. As we wrap up, let's take a step back and look at the big picture. The silver and gold markets are entering a phase that very few investors are fully prepared for. On one side, you have record physical demand, 2.4 million ounces of gold and over 41 million ounces of silver already stood for delivery in just the first 2 days of December. On the other side, Western exchanges like the COMEX and LBMA are showing cracks. Delays, outages, and stretched delivery systems signal a serious strain. The message is clear. Physical metal is more valuable than ever, and trust in paper markets is weakening. Geopolitics and global strategies reinforce this trend. China is flying around Latin America, buying ore, and concentrates at premium prices, building long-term supply chains and restricting exports. The EU and the US have classified silver as a critical mineral. Sovereign wealth funds, central banks, and industrial giants are quietly accumulating, preparing for a market where paper promises are no longer enough. Asia is positioning itself to dominate physical silver and gold supply, while the West is scrambling to respond. From a technical perspective, everything points higher. Silver's cup and handle breakout projects a target near $96 based on historical highs and ratios. Gold is poised for new all-time highs above $5,000. Junior and senior mining stocks are forming bullish patterns that could amplify gains. The gold to silver ratio shows silver is undervalued, meaning any acceleration in physical buying will create outsized moves. Every consolidation we see is simply a pause before the next leg up. For investors, the strategy is clear. Prioritize physical ownership. Paper contracts are increasingly risky. The system relies on trust, and trust is breaking. Those who understand this are quietly stacking metal, dollar cost averaging into silver and gold, and preparing for a historic bull market. This isn't hype. This is structural, fundamental, and technical reality. Every failed breakout, every delivery spike, and every liquidity injection by the Fed points to the same outcome: a move to real metal, real ownership, and historic prices. Retail investors often sleep through these setups, thinking markets always bounce back, or the Fed always has their back. But the smart money is already acting. When the system finally reaches a breaking point, price discovery will shift east, with Shanghai leading the charge. Cash and carry physical metal will replace rehypothecated paper contracts. Those who hold physical silver and gold will be positioned to benefit, while those relying on promises will be left exposed. In short, silver is the asset of the decade, and gold is the anchor of stability. The technical patterns, delivery data, and geopolitical positioning all point to higher prices. Stack smart, stack physical, and stay informed. This historic bull market is just getting started, and the moves you make now could define your financial position for years to come. Stay with Gold Rush Reporter for updates, analysis, and actionable insights as we navigate this unprecedented precious metals market.